Hi, everyone, and welcome to Case Study. So what I'm going to do today is go through a case study of a real client, names change, and to show exactly what we do in a strategy session. So the way we help people to understand what we do, one, all the content we've got out there, but ultimately people book a strategy session with us. It's a wealth potential strategy session, so we can show them potentially what their planning could be. And it's based on our real financial planning framework, where we have a core belief that the best financial decisions are made as part of a real plan, one that has goals, crystal clear picture of where they're at the moment, and smart strategies. All that comes together in a plan, which is exactly what to do, when to do. But the secret sauce is it's all about action. It's all about implementation. It's getting things done. And this is the number one thing that stops people from achieving financial freedom is they just don't have the time, the confidence, the knowledge to get it all done. So that's where we step in and we help people do that. So I'm going to go to our case study today. We're going to go quicker. This would normally take us 40 to 45 minutes with the real client because we take the time to get to know them, not just their numbers as well. But I'm going to show you the numbers. And first of all, we're going to start off with looking at the current position of where they're at. Now, this is our financial planning software where we can build that clear picture, we can build the goals, and we can model the strategy so we can show people exactly what they're on track for. So in this case, we've got two clients. They've got a home worth 1.2 million. They've got a mortgage of 175,000. They're paying 17,000 a year off that. They've got a bit of cash. They've got 250,000 of super for one of them and 170,000 for the other. And they've just set up with their existing financial planner a share plan where they were invested about 70,000 and they're investing $1,000 a month. So that's up to about 80,000. They came to us dissatisfied with their existing financial advisor because it seemed to be all about the products and not about a real plan. So they had no idea whether they were on track for retirement. And in this case, one of the couple was having some health issues and she wanted to just know that she didn't have to work forever. So in this case, these guys are about 48, 49. So they were looking to be able to potentially retire early, but lots of questions. They know they're nowhere near ready yet. So one of them was earning 120,000 after tax. That's 90,000. The other one, 80,000 after tax. That's 63,000. We worked backwards to work out they're probably spending 115,000 a year. They didn't have a great deal of surplus, a little bit, but by the time a bit of travel, a bit of this, a bit of that, no real firepower. So very important to look after the surplus, but to see where their current strategies are going. But first, we set some goals. So we go through some questions. How much are you going to need in retirement to pay for a good life? So they thought 80,000 would do that. But we also asked what they'd need for that, the nice things, the extra travel, etc. So another 20,000. So their target, 100,000 for life. They didn't want to budget any lump sums for toys or anything like that. And in this case, they had no children. So there was some conversations about not needing to pass on any big legacy. And I'll come back to that in a minute. So we put in their existing stuff. So we have a look at their super. So a quick chat about their current super fund. And we assessed that a reasonable likelihood return for that was about 6%. Based on their salary plus the superannuation guarantee for each of them. It shows their combined super going from about 420,000 to in 10 years about 1,074,000. Sounds like a lot of money, but let's go back to that scoreboard where we set those goals, and that goal, our calculator says you really should have about $1.8 million to provide 100,000 for life. In 10 years' time, that's going to be 2.3 million. So super is getting somewhat there, but not completely. We then had a look at the mortgage. And by the way, in 10 years' time, they'd still have a mortgage. So the green line here shows the mortgage based on their current repayments. So when we put that together, the one other strategy they had was their portfolio, 80,000 portfolio plus 1,000 a month, which is an awesome thing that they're doing, but it's going to build 350. So we come back to the scoreboard and it shows them building about 1.355 million, which is okay, but the target's 2.3. So it's kind of short, or is it? And that's where a deeper conversation with them about family structure and potential legacies or inheritances led the fact that for one of them, her parents are in their mid-80s, not too healthy, And when we asked the question, are you likely to come into any inheritances? She said, yeah, she's the executor of her parents' wills, and she knows with their properties, it's probably going to be about 2 million to each of her and her sisters. Now, in the middle of the biggest wealth transfer in history, as money's passed down off the back of the Australian property boom over the last 40 years as well, there's substantial estates for many people, not everyone, but certainly for many people. So in this case, this was reality. So I said, well, let's adjust my target. I've got 1.8 million that you'll need, but let's play around with that. So we put in, they were heading towards 1.3 million. I bring that back to today's dollars, which is $1,054,000, and then say, well, if you drew 100,000 from that, you're going to run out of money in 14 years. So in 10 years' time, they'd be 59. You don't want your money to run out in 14 years. But then let's look at the reality of an inheritance. Now, we never want to be morbid about this. Parents in the mid 80s. So let's say, and they're not very well, so they're in decline. But let's just put it out 15 years. So we've already got a plan of 10 years to get to these numbers. So we put in 5 years, an inheritance of 1.5 million, super conservative. If there's $2 million worth of property right now, that will turn out to be conservative. We want to show them what effect that has. So look what that does. That means if they retired right now, or at the time with the equivalent of $1 million in today's value, and they spent 100,000 a year out of that portfolio, but then they added $2 million from the inheritance, that money would last forever. Now, they don't want it to last forever because they don't have any children. They don't need to leave big legacies, so they're happy to spend it down. So we said that could actually mean they could spend more. So we played with, say, 10,000 a month, and we go, yep, that's now starting to look like a plan. So all of a sudden, we've got 120,000 a year, super comfortably in 10 years, but we haven't looked at tweaking strategy at this stage. So we go back to our software and we start to play around. So one of the things we noticed is we can probably get smarter with their super. So yeah, we take all our potential clients through a process of understanding risk and return. So even if we're conservative and if we can get an extra 1.5% for their super in this case, for each of them, that's going to bump up and add, about 148,000 just by getting the risk profile, the asset allocation right, and being intentional about your super. Most people just make decisions on super based on the default options. Occasionally they'll put into a high growth, but most people just land in a super fund and stay there for a long time. It's much better to be intentional and make sure you've got superannuation that's specific and appropriate to your plan, where you've got a plan. So we've added 148,000 in strategy there. Let's have a look at the home loan. Now, we know they're investing 1,000 a month. So, and they've got a portfolio. But in this case, the advisor didn't debt recycle that. Now, debt recycling, some of you will have heard me talk about it. Debt recycling is where we take, we want to pay off bad debt, which is the mortgage, and we want to create good debt, which is investment debt. So in this case, we're going to sell the existing shares, and there was no real capital gains tax when we looked at on this portfolio anyway. We're going to take it and we're going to pay it off the mortgage. So we're going to knock 80,000 off the mortgage. So straight away that chops the home loan down to 7 years. Now we're going to add that $1,000 a month they're putting into the portfolio. We're going to add it to their home loan repayments. That now chops their home loan down to 4 years. And then we're going to assume that once they've finished paying the home loan, they invest that outside of super, because we want this we're going to build a share portfolio as well. We're going to build a portfolio with borrowed funds. So we're going to get them to set up a line of credit. We're going to borrow back the 80,000. Then we're going to borrow back 1,000 a month. So it's exactly the same investments, exactly the same debt, but we've recycled the debt. So we now pay off the mortgage, which is non-tax deductible, super quick, and we build up some investment debt. So with that strategy, we go back to our scoreboard and we've bumped up their worth by about 1.64 million. Now, in fact, we'll do that even better because we'll eventually say, well, we've now saved them tax. So that 80,000 of debt we paid off and then borrowed back, the loan on that is now tax deductible. That creates a tax deduction of about 4,000 to 5,000 a year based on current interest rates. That's going to be a tax refund of $2,000. So we can actually take that and we can add it each year to the portfolio as well, or into super. Let me just call that $200 a month. So we put that in. It's not much, but it boosts up our scoreboard even more. So we're now at 1.68 million. That 1.68 million is about 1.3 million in today's dollars. So even though it's not at our perfect goal, they don't need the perfect goal because we know the inheritance. So we can plug in the 1.3 million back into their projector on how long their money is going to last when they do retire. And wow, it goes out further. So we can actually say you can probably afford to spend more like 12,000 a month in retirement. So that's going to be a luxurious retirement. Maybe it's about 11, but we can play around and keep in mind, this is version 1 of their plan. And the other thing we can work on now is instead of working for 10 years, maybe if they stuck with their original goal, and you might recall that was 8,333 a month, instead of working for 10 years, we can then bring that back and say, well, let's see where that is in 8 years. And in 8 years, they will be, oops, let's get that right. 8 years, they'll be at 1.3 million. And we know that's about 1,054,000. So all of a sudden, we've shaved 2 years off their working life. And for them, one of them with health issues, that is such a relief. So with the mortgage, yeah, and they're back to 10,000 a month. So above their goals, shorter time frame, and just smarter strategies. So that's an exact example of what we do in a wealth potential session. I've done that really quickly. We do it much slower. That whole process takes about 45, 50 minutes. And it's very important that we take the time to understand you, your goals, your situation, and then we'll play around with your existing strategies. The software we use is state of the art. It's something I designed years ago, and it allows us to show people exactly their plan in real time. But don't forget, it's all about implementation. I just made it look really easy, but we know less than 10% of people get to high quality retirements because they put things off, they make mistakes. So it's all about implementation. And that quite simply is what we do. If you'd like your own wealth potential strategy session, click on the link below in the notes to the video, and you can arrange online an initial phone call where we'll screen to see if you're suitable for our wealth potential session. And then if we come up with a plan that works for you, we can then talk about whether you want to hire us to get the plan done and implement. Hope this was of value. Until we talk again, Rob McGregor signing out.